In today's video, we are going to be going over a cryptocurrency and Forex trading strategy that proves effective for both day trading and swing trading. Whether you prefer holding a trade for a few hours or a few days, this strategy is versatile enough to accommodate your approach. What's more, it transcends various markets, allowing you to apply it seamlessly to Bitcoin, other cryptocurrencies, Forex, or even the stock market. By the end of this video, you'll be fully equipped to implement this strategy instantly into your trading endeavors. I hope you find it enjoyable and informative. Did you know that approximately 80% of the time the price isn't in a trend, but rather fluctuates within support and resistance boundaries, other known as ranging? Our goal is to capitalize on this by buying at support and selling at resistance. Before executing any trade, it's crucial to address three key questions. First, are the support and resistance levels clearly identifiable? Second, is there confluence at these levels? And third, does price action align with my trading direction at this level? If the answer is yes to these three queries, the trade should be executed without emotional influence. Consider this Bitcoin chart for illustration. Initially, we observed that the 4-hour level has consistently acted as support and resistance, and as price is currently below the level, it is acting as resistance. Consequently, we mark this as our resistance level. Seeking confluence, we use the Fibonacci retracement tool, revealing that the GP and the 0.786 are in close proximity. Subsequently, we patiently await price to revisit this level on lower timeframes. For short positions, our trigger is either a shooting star, a spinning top, or a bearish engulfing candle formation. If such signals are absent at the designated level, we refrain from entering the trade. Let's explore the lower timeframes to observe the unfolding scenario. Now, examining the 30-minute chart, during the initial touch, a well-formed spinning top candle emerges, serving as our entry trigger. At this point, we initiate a short position and set our stop loss just above the high of this candle. Now let's take a look at how price action unfolded. As anticipated, the price descended, and we closed the trade at our support level, which consistently aligns with the 0 point of the Fibonacci retracement. Analyzing the risk to reward ratio, the strategy involves risking a small amount to potentially gain significantly more. For instance, a risk of $100 on this trade could yield a profit of $1,400, emphasizing the principle of risking a small amount to potentially gain significantly more. Regarding the decision to close the trade, it aligns with the strategy tailored for trading within a range. Closing at the support level is consistent with the range trading philosophy, as it acknowledges the uncertainty of whether price will break the support or rebound from it. The primary objective is consistent profit extraction from the market through repetitive execution of this process. Now let's dive into another example. Examining the Ethereum USD chart, it becomes apparent that a specific 4-hour level has consistently functioned as both support and resistance on multiple occasions. With the recent break of this level as support, the anticipation is for it to transition into a resistance zone. Utilizing the Fibonacci retracement tool, we investigate for confluence in this vicinity. Notably, the golden pocket and the 0.786 retracement aligns closely with the identified 4-hour level. Subsequently, we adopt a patient approach, awaiting the price to ascend and closely monitoring the developing price action at this level on lower timeframes. Let's now shift our focus to the 30-minute timeframe for a more detailed analysis. Observing the price movement, we note a rejection from the identified area. However, despite this, there is an absence of any bearish candle formation at this point in time. Therefore, executing patience, we continue to monitor the situation until a bearish engulfing candle emerges. This candle serves as a clear indication that price action has turned bearish at our crucial resistance level. Consequently, we initiate a trade at the closing point of this bearish engulfing candle and position our stop loss just above the candle's high. Now let's dive into the subsequent developments of the trade. The market responded with a downwards movement, leading us to execute the trade closure at the support level, coinciding with the 0 point of our Fibonacci retracement. The same systematic approach is applied when considering a long position. In the presented chart, the 4-hour level has consistently acted as support. Accordingly, we mark this level on our chart. Employing the Fibonacci retracement tool, we identify confluence between the golden pocket and the 0.786 with the 4-hour level. The strategy involves waiting for a price retracement and closely observing the price action at this level on the shorter timeframes. For long positions, our trigger is either a hammer, a spinning bottom, or a bullish engulfing candle, signaling the favorable moment to enter the long position. Let's transition to the 30-minute chart for a more detailed examination. Upon price's return to the identified 4-hour level, a well-formed spinning bottom candle emerges. Recognizing this candle as our signal, we execute the trade, positioning our stop loss just beneath the spinning bottom candle. A short while after, the price even retests our support level, whilst also forming a hammer candle, presenting us with a second entry, whilst strengthening the possibility of the move. Now let's explore the subsequent developments in the market. The market responded with an upwards movement, prompting us to conclude the trade at the resistance level, consistently aligned with the 0 point of the Fibonacci retracement. Evaluating the risk to reward ratio, we took on a risk of 1 to potentially gain 13 times more. In practical terms, a $100 risk on this trade could have resulted in a $1,300 gain. This approach emphasizes the principle of risking a small amount to potentially gain significantly more. It's evident that trading becomes more manageable when you possess a clear understanding of what to observe and act upon in the market. If you're finding value in the content and enjoying what you see, feel free to drop your thoughts and feedback in the comment section below. Don't forget to hit the thumbs up button. Your support is truly appreciated and encourages us to keep delivering quality content. Thank you for being here. Transitioning to Forex, specifically the Euro-USD pair, we pinpointed a 4-hour level that consistently served as resistance in multiple instances. Marking this level, we applied the Fibonacci retracement tool, revealing a confluence with the golden pocket and the 0.786 zone. The next step involves waiting for the price to revisit the area whilst closely observing the price action on shorter timeframes. Now let's shift our focus to the 30-minute chart for a more detailed analysis. Observing the price action at the identified level, a distinctive shooting star pattern emerged, serving as our signal to initiate a short position. To manage the trade, we strategically placed a stop loss just above this candle. Now let's explore the subsequent developments in the market. The market responded favorably, with the price experiencing a decline, allowing us to close the trade with a substantial profit at our support level, the 0 point of the Fibonacci retracement. Now let's move on to another example. In this chart, we identify a daily level that has historically functioned as both support and resistance. Marking it as our designated daily level, we proceed to seek confluence by applying the Fibonacci retracement tool. Notably, the golden pocket and the 0.786 aligns closely with our identified daily level. The subsequent step involves patiently awaiting the price to revisit this support area and closely monitoring the price action on lower timeframes. Now let's shift our attention to the 4-hour chart for a more detailed examination. Observe the market's response as the price returns to touch the identified daily level. A notable development is a clear formation of a hammer candle, a robust indicator of bullish price action at a key level of support. In response to this, we initiate a long position and position our stop loss just beneath this hammer candle. Now let's see how price action developed. The market exhibited a shift in direction, with the price ascending, leading us to close the trade at the resistance level, consistent with the 0 point of the Fibonacci retracement. Now let me show you this again using another currency pair. In this scenario, we recognize a 4-hour level initially functioned as resistance. However, a recent break of the level means the anticipation is for it to transition into a support level, prompting us to mark it on the chart. Subsequently, we utilize the Fibonacci retracement tool, revealing a confluence between this 4-hour level with the golden pocket and 0.786. Once more, our strategy involves patiently waiting for price to descend, all the while closely observing the price action in this area on shorter timeframes. Let's now transition to the 30-minute chart for a more detailed analysis. Observe the market dynamics as the price revisits the identified 4-hour level. Notably, a hammer candle takes shape, serving as our signal to initiate a long position. To manage the trade, we strategically place a stop loss just beneath this hammer candle. Now let's see how price action developed. The price experienced an upwards movement, as the identified level served as robust support. Consequently, we closed the trade when reaching our resistance, consistent with the 0 point of the Fibonacci retracement. It's crucial to note that the golden pocket and the 0.786 zone isn't employed as an independent strategy. Rather, it is utilized in conjunction with support and resistance levels, alongside close monitoring of price action at these levels. The significance of the incorporation of the GP and 0.786 lies in the fact that many traders, along with automated bots and algorithms, closely watch and consider this level in their trading decisions. Now, let me show you one final example. Examining the Bitcoin USD chart on the 4-hour time frame, the key question arises: why did the price come to a halt precisely at this level? Initially, we identify this as a 4-hour level that previously functioned as resistance, prompting us to mark it on the chart. Subsequently, applying the Fibonacci retracement tool from the high to the low points, a noticeable confluence emerges between the golden pocket and the 0.786 with the 4-hour level, establishing it as a strong resistance region. Now let's dive into the price action on the lower timeframes when the price revisits this level. On the 30-minute chart, pay attention to the bearish price action, as the price returns to the identified 4-hour level. Notably, a distinctive shooting star takes shape, serving as our signal to initiate a short position. To manage the trade, we would strategically position our stop loss just above the shooting star. Now let's explore how price action develops in the market. Price experienced a decline to the support at the 0 point of the Fibonacci retracement. This emphasizes that trading isn't about guesswork. It becomes more straightforward with a well thought out plan and a solid understanding of price action, focusing on key support and resistance levels. For those eager to delve deeper into this concept, click the first link in the description or the pinned comments for an instant enhancement of your trading skills. If you found this video helpful, kindly share your thoughts in the comments and give it a thumbs up. Your feedback is valued. Thank you for watching and stay tuned for our upcoming videos.